Hey everyone, Chris Lopez here, and today I've got Terrance Doyle and Ben Davis back in the office to talk about a 40-unit multifamily building they're taking down here in Denver. Gentlemen, good to have you back.
Good to see you, Chris. Correction, we actually took it down 2 weeks ago.
Oh,
Acquired
right.
2 weeks ago.
What did I say?
Right. About to take down.
Oh.
Past tense.
All right.
Yeah, we did it.
Good to know.
We did it. Yeah.
All right, so it's already
It's
taken
been
down.
taken.
Okay.
It's been taken, yeah.
All right, Ben.
Yeah,
what else
it's
did I
good to
say
see you
incorrectly?
in the present tense. I'm glad to be here, presently.
All right, so we are on a tight timeline while we're recording this. We got some meetings after this, so let's jump into it. Give me the overview of the property and how you guys took it down.
Very interesting scenario. This deal moved very quickly. Typically in Denver, in the past couple years, it takes 6 to 10 months to get a deal done in our space. Value add, motivated seller. There's a lot of moving parts with debt and, underwriting the leases and getting the lender down and getting the seller to the price that we need it. This deal moved really quickly. So I walked the building probably the last week of August. She was asking $5.5 million or something ridiculous. And then a few weeks later, they actually lost their VA certification. So they had half the building was filled with veterans.
Okay.
And they're on subsidized leases paid for by the government. They had failed 3 or 4 inspections. I didn't totally get the whole
health
story.
and safety inspections?
Oh yeah, health and safety. Just because of how poor of condition the building was in, some of the boilers didn't work. I mean, it was really, really bad. And so she lost that immediately. Half the building was vacant.
Just because all those VA tenants moved out.
That's right. The VA moved out a lot of them. There's still some left in there, but moved out a lot of them. So then I get a phone call probably the third week of September, something like that, and she was at $5 million. So she had dropped at 10%. And this is not on the market, just called a broker that she was really close with. This is a seasoned vet, so she's owned hundreds and hundreds of units, maybe thousands in Denver. She's a broker herself and a property manager. Had owned it for 30 years, had a partner in LA that supposedly was really motivated to sell, wanted a quick sell, needed some liquidity for some other stuff he had going on. And then she had some health stuff going on. So you had 3 parallel tracks of everyone was motivated, where you had the building being half vacant, she's going through some health stuff, some other guy is really motivated by needing cash. So she dropped at 10%. And so we put it in our contract at right around $5 million. Then we went through and did our inspection.
Sorry, I made the time. This was mid-September.
Mid-September.
Okay.
Yeah, mid-September. And we ended up closing, we were supposed to close the last week of October, but because of some stuff that they had with the VA, we ended up closing the first week of November.
So that's, what, a 6-week, 7-week contract?
Yeah, 6 weeks, yeah.
That's
right.
Very quick
pretty quick
yeah.
for $5 million, yeah. So then we did our inspection, and basically found out that everything needed to be redone. So the boiler, the roof, the decking on the roof, the windows, the plumbing, the electrical. I mean, this place was drug infested, bed bug infested. I mean, it had everything. It was in really, really bad shape. So we basically had a call with the broker and said, look, this is definitely a deal. It's up our alley. The seller's really motivated. The property's in really bad condition. There's a ton of vacancy. I mean, it checks all the boxes for a deal that we would do. But this price, I mean, we need like $700,000 or $800,000 off, and I don't want to hurt your relationship with the seller. He was really close with the seller, and so let's just terminate. And he was like, well, why don't we submit something and let's see where they're at. So we submitted originally like a $900,000 concession based on the inspection, $900,000, which
Wow.
I've never submitted anything even close to that.
You almost broke the 7-figure mark on that. Wow.
Yeah, that was wild. And surprisingly, they were actually pretty receptive to it. I mean, obviously they were upset, but they communicated they wanted to keep the deal together. He basically sent them two documents. One is a termination, and the other one is, hey, here's the $900,000, inspection objection. What do you guys want to do?
So sign the termination or sign the objection.
That was the way we approached it. And I think that was really smart on his part. Like, hey, we understand that this is a big pill to swallow, and it may not make sense. We also submitted it with the full inspection report along with the bids so that she could see that we're not making any of this up. And she had the numbers to call our contractors to see, hey, the roof is going to be 100, the boiler is going to be 150, the electrical's this, all of these items that needed to be that needed to be corrected. So that made it a little bit more digestible, apparently, from their standpoint. And the long and short of it is they ended up agreeing to a $600,000 price reduction, which got us to pretty close to $4.4 million, 4.45 to be exact. And that was a number that was basically at the highest end of where we thought we could make it work. And so, yeah, that ended up, we were able to, we basically, our earnest money went non-refundable at that point, and then we, had to get the rest of the appraisal done and the lending and all those items, and then they had to get some things worked out with the VA, some of the tenants that they had agreed to with the VA to help them move because of the conditions of the property. So we needed that done before we closed.
So I know, I think 2 episodes ago, you talked about a property that you did through HUD.
That's right.
Which is a government agency, which obviously that was a lot of paperwork and lawyers and due diligence involved.
Right.
Since this was VA, did you have nearly that much amount of headache, or because the VA terminated that to kind of like make it more of a normal process?
So every tenant has their own advocate with the VA, their caseworker.
Okay.
And so it depends on the caseworker and how, the condition and what the, some of the tenants have health conditions and it was more serious than others to get out. Other ones had maybe disabilities and they need, so every tenant from the VA, every client of the VA has a different situation and a caseworker that represents them. So it definitely wasn't even close to what we went through with HUD, but there were still some issues and boxes that needed to be checked based on the way the lease was signed and the tenant's situation.
Right now, what was the condition of the property? Because we've had a few conversations
Right.
just in passing on here, and this sounds like it's in the subpar condition.
You and I have walked a bunch of our buildings that we've done and
Yeah.
seen it. I mean, this is up there with one of the worst. It's larger, right? So I think that's what made it scarier for most people.
And actually, so this is a 40 unit.
40 units.
And what's the unit mix like?
34 ones,
Right.
4 studios, and
2 twos.
2 twos, yeah.
Okay.
2 twos. So it's primarily one. So it's 3 12-unit buildings of 11 one-bedrooms. They're 780 square feet, so they're large. They're oversized ones, the exact same layout. And the 3 studios, so one in each building, is in the exact same place, same layout as well. And those studios are 650 square feet. So what we liked about it was there's several things that made a lot of sense. There's a brand new housing development that got built by Brookfield 3 blocks away. And it's 300 or 400 lots, and it got built, started in 2016. They sold out the last phase of it in 2018, and across the street they put a brewery, a bar, and a coffee shop, along with a new townhome development that's currently getting in the last phase. So you have some brand new product. The price points are between $500,000 and $900,000. So brand new
For
product
single family.
for single family, 3 blocks away, and then you come around the corner, and there's this dilapidated apartment building in this residential neighborhood. So there's not a lot of other rental stuff around. There's some condos, but this would be, it's the only apartment building within like 8 blocks. And part of the due diligence was, the closest apartment building was a 200-unit building that was on Pecos. We went into that building, got to walk a couple of the units. Out of the 200 units, there was 2 vacancies. So that was a really good sign to us that in that area there is a strong demand. There's not a lot of supply. So that was one of the deciding factors when we were going back and forth with the seller of, on the concessions and the price reduction. It made sense for us based on the location, the new build, the people are moving there, and there's really good job creation around there. There's a bunch of, restaurants, bars, gyms. I think there's a Walmart close by, a Target close by. So there's some things in the area that made sense, and the brewery and some other stuff that I think are going to be attractive for the new tenant class that we put into the building.
And what neighborhood, or like what are the major cross streets nearby?
69th and Pecos. So
Okay.
it's called Twin Lakes.
Yep.
So North Denver, not an area that I'm particularly familiar with. The more we dug into it, the more we thought was interesting. I think the biggest key was just the supply and demand. There seems to be really good demand there and not a lot of supply. And we think when we bring this building out, it'll be the nicest product for an apartment building within a 1-mile radius, and it'll be priced under what that other building is that's a 200 unit.
So high level, this is kind of like your standard value add play. Just go in there, update the whole property, update the units, bring up to market rent, and then sell it a couple years down the road. Is that
Absolutely.
Okay.
Yeah, so it fit right down the middle of the fairway for us, a deep value add play where we could completely renovate and redo every part of this. So the hallways are going to be brand new, the units, the roof. I mean, a ton of capex as well as cosmetic stuff, and we'll be able to re-tenant the entire building at one time.
So Ben, I know you do the finances. So we got the visual description of the property, which sounds like it's needs some love. What were the numbers like on the takedown, and what's the financial model for everything from the takedown to rehab to the exit?
Yeah, sure. So, like Terrance mentioned, we finally settled on 4.45. So, it was, from our standpoint, that was a big win. We were ready to walk more or less as far as price. One great exercise for our team, and underwriting the lease up phase on this deal was uniquely challenging because, like you said, there's not another apartment building for 8 blocks, and so our standard procedure for a rent study, there was a ton of holes. It's just too far, to say, well, someone pays this price for a 1-1 and it's 2.5 miles away. That can be totally irrelevant if you cross from Rhino over to.
Especially in that part of town, there's
Exactly.
That's
drastic
That doesn't mean
differences.
anything. So we had to look at a lot of median income, what percent of people that work here, what do they invest into their housing situation. Look at these condos, even though that's a different product. It was a real challenge, and we ended up being very conservative as far as the rents we were going to put in after stabilization, or the rents that we anticipate after stabilization. And at the end of the day, one thing that's unique to this model is we underwrote a per unit sales price, a per unit disposition price, vice, and NOI, and then we try to kind of match the two up, meaning, okay, we're more confident that this building will trade at a per door price than the typical cap rate NOI equation. And then from there you can say, okay, well,
why did you think that? Like, what was the reasoning behind that?
Well, you can arrive at rents if you're confident in the disposition per door cost. So let's say you just multiply. We thought this will easily trade for 170 a door, 170,000 a door. Multiply that by the units. Generally, I'm skipping a few steps.
Yeah.
And you get $7 million. And you say, okay, well, what rents at a 6.25 cap would also give me $7 million? Okay, those are the rents. So it's kind of, it's just solving for X on the other side of the equation.
Okay.
And so that's, that was unique to this deal. We knew more about what the per door disposition price would be than, speculating what people would pay for rents.
It's really because the rents were so unproven, right? Because we're talking about a 40-unit building, and it's the only one. It's only mid-sized apartment building within like a mile and a half.
Really?
So there's not a lot of great comps. Yeah, so that was one of the. So it's a plus and a minus. So for doing your due diligence, it wasn't great. But then on the sales side, we think it's going to end up helping us. And on the lease-up side, because there's not a lot of C product that's been renovated. There's none, really. There's one larger building that has some amenities, but that's not really a true comp. So when you look at comps in that area within 2 miles, everything, especially renovated. And there was one that recently traded at 180 a door. That was some 1s and 2s. And if you look at anything, as you know, the Denver market, most things renovated in Denver are trading between, that has a mix of 1s and 2s, especially this size, is trading between 170 and 200 a door.
Mm-hmm.
And we're buying this at a basis of 111. So naturally, we, even though the rents we were unsure of, we were pretty sure that, and this is our full-time job, so we know what multifamily is trading at. We were pretty confident in what the back end is. We just weren't totally sure on the rents. One, because we haven't done anything in that area, and the other, number two, is there's not a lot of B- product that's been renovated and turned in that area.
Gotcha. Okay.
Yeah, there was a few late evening phone calls between Terrance and I saying something's not adding up. We're buying it at 111. We know it'll trade 165, 170, but where are these rents? Something's in the model is to, there's a deal, basically napkin math, and you just have to, you can kind of derive the rents by working backwards.
Okay.
Is what I was kind of trying to explain. So
no, that makes sense. That's just part of the detective work you have to do.
Yeah, and then,
right.
Basic economic, high school economics, the less supply, of the product should be good for the asset.
Now, can you model that in a spreadsheet though? Because like from a fundamental standpoint, I agree. It can be a little scary looking at, but then how do you model that?
That's a good question. I'll
Okay.
put some deep thought into that. I guess you could correlate. You could assume people don't like long commutes. So if you found densities of employment and a lack of multifamily, you could probably come up with some kind of, the
formula.
Yeah, that's a good question.
I love how your brain works because that is really interesting.
The big key on the underwriting was we could make some assumptions, and at some point you have to say, because of supply and demand and because of Denver and migration, and that there is a shortage of affordable housing, we were able to put in some rents there that we felt pretty comfortable with, that are still appropriately conservative, and that helped us arrive to, hey, this is still going to, that helped us match the $170 a door back end price with the cap rate.
Right.
Can you walk us through some numbers?
Sure. So,
like, may I ask you this way, when you bought it, what were the rents, vacancy, expenses? Like, I'm assuming it's a pretty low NOI if it's...
Oh, yeah, I love looking at the average rents
there was rents as high as $1,065 in the twos, and then as low as $750, and then a lot of incomplete payment, non-payment. Like he said, the VA tenants had moved out. So it wasn't like, add the units and divide by the total. And so what we do is we just use some product, same as a blended average, and that was $765 a door. So really low.
Was that including the vacant ones, or those are just the paying ones?
No, that would be if you blended if the paying tenants were to fill all the units and pay consistent with the existing, that's what the average rent would come out to be.
Wow, that is low.
Yeah.
And what was the vacancy when you bought this?
50 or a little less.
It was a little over 50% when we closed.
Okay.
A little over 50%. Yeah. There was 18 tenants in there when we closed. 22 vacant.
So I want to jump ahead a little bit, because just talking about how the way you did some of the backwards math to figure this out. When it came to the financing component, did that cause any issues with lending?
Well, this was a new lender who I wouldn't say specializes in this type of project, but he understands it. And the way this company works is he's a debt broker, and is a debt broker different than a commercial, like a typical debt broker,
commercial lender?
A debt broker is someone who takes the client, says, okay, I hear the loan that you're requesting. I have everything I need to know. I trust you. I've underwritten you. And then he takes the package and he presents it to maybe 35 credit unions, 12 credit unions, 2 credit unions, 10 banks. He puts it on Wall Street. I mean, there's no, in private equity that could be, they could shop it to Goldman Sachs and
so they're shopping around to local banks plus Wall Street.
So he's not
equity.
the one. He isn't the bank that holds the cash.
Yeah.
He has
a
relationship with banks.
Yeah.
And they were kind of oversimplifying it, but they're saying, hey, if you guys, we're underwriting you and you're guaranteeing the cash. So you come present a loan to us, we'll fund it, and if the person defaults, we're going after the brokerage firm, and then the brokerage firm would come. So there's a middleman between the bank and us.
Oh,
He's brokering debt from multiple avenues into us.
The bank's actually out of Kansas City. It's like a farming bank out of Kansas but he's been ultra successful as a debt broker, mortgage broker in the commercial space, done a bunch of different things. So we actually get a really favorable loan for the project, and he was able to look at, basically my balance sheet, track record, and look at the project and what we were going to do with it, and was able to give us a construction loan to stabilize the project. So we ended up getting 80% of total cost.
Wow.
80% of total cost, which would be unheard of for a Denver bank to do. But because of his relationships and his track record with these smaller regional banks, he was able to get us a really favorable loan despite the risk in the vacancy, which, especially during a pandemic.
During COVID too.
Yeah, it's been like banks are not, they would not even, like First Bank wouldn't even touch this, and a local bank wouldn't have touched it. So it was awesome. I mean, that was a huge value add from his standpoint of being able to put us into this kind of loan and we only pay interest on the debt that we use from the line of credit for construction.
So you got to understand that. So you got your loan to take down the property,
That's
and you
right.
also got a line of credit for the construction.
That's right,
costs.
and it was 3.5%.
So let's talk about.
So
Can we talk about those terms? Some like just
Yeah.
down
Sure.
payment terms,
Right.
prepayment.
Yeah, so typical deal, syndication deal that we do, we get a loan to value 60 to 75, 80 from the bank, and then we use equity for the delta between the 75 LTV and the total acquisition cost, and then we also raise equity to fund construction operating expenses. So in this case, which really was coincidental timing, we were kind of trying to build a relationship with this broker without a deal really in mind. We were just kind of saying, hey, this is our track record. This is the kind of deals we do.
Mm-hmm.
We think you'd be a great candidate. We're doing that all the time. Almost every day I'm trying to move that ball forward. And then this deal that had a huge construction, a huge renovation budget by percentage, came along, and it was the first one we sent to them. And it was a great fit. The reason that's so significant, Chris, is because if we borrowed the construction funds at 3.25%, and the alternative to that would be to raise it from our limited partners at a minimum of an 8 pref. So we're saving 475 basis points on the construction cost.
It's a lot cheaper.
Yeah,
debt.
and that obviously benefits us, but that trickles down to the limited partners also.
Yeah.
Because the debt costs or the interest payment is much lower to the project as a whole. So everyone wins.
Okay. So let me. I know. I'm sorry. I know I'm jumping around here, but like this.
No, sorry, I keep going on tangents.
No,
I'll
this
answer
is
your
good.
questions. Yeah. Yep. Okay. So it was 80% loan to cost, but
Okay.
really when you get into the documents, what that was 80% of the purchase price. We'll call that the A note, and then the B note was a line of credit for 80% of the renovation budget. And so, packaged together, that is 80% of total cost, but it was really two loans. So we raised the rest of the money, on top of 20%, and that total came to 1.35 million.
Okay, and so you raised about 1.35 from your limited partners
That's right.
to fund the 20% down payment.
And what's interesting about that is it's a larger deal than we've done, a 40-unit deal. The purchase, the total cost is going to be somewhere around 5.6, 5.7. So typically in a deal like that, we would have raised $2.5 million. But what was nice about getting the construction loan is we had to raise less money, which is going to juice the return for all the investors,
That's right.
which is going to be massive.
Yeah.
So that was a huge, especially during the pandemic, as you've seen debt, what's going on right now. I mean, no one's touching 80% on anything, much less on a property that's half vacant.
Yeah.
So it was huge. It was a huge win to get that financing. It really made the project pencil out. Great for our partners, and we ended up only bringing in 5 LPs on this one.
Mm-hmm.
So it was just a small group of people that we had a relationship with, and a bunch of that had done transactions with in the past. Kept it really small. It was such a short window to raise the money and to execute, to close, because of the situation of the seller being so motivated. So it was one of those deals where we just put it out to a small group of people that we already had a relationship with, because of the time was a big factor in closing.
So from like a high level, Ben, since you're able to fund the construction through the loan, like from a high level, like how much higher return do you expect that to give to the investors? Because you're just getting more leverage,
Right.
And when it works in your favor, more leverage is good,
Right.
from a high level. So it should increase return. Is that like a half a multiple, a 2 multiple?
Well, to solve that, so you would take the difference between what is provided by the lender and what we would have taken from the limited partners, and then apply 8% vice 3.25, and then subtract those two numbers. That would be your savings. So basically, what did you not pay the limited partners in interest, because you got to pay the line of credit debt at
Okay.
3.25, and then you would add that, you would spread that total across 24 months, which is the project length, on the debt payment line, and then look at the return, and then you would know how much. Which I could work that out, but it's not in the model.
Okay.
I would speculate significant.
Because I know you said you took it down
2
for
points or so.
4.45. And you guys raised 1.3. So
Yeah,
how big is the
4.45.
construction
We're gonna
loan?
put in roughly between 750 and 800 after we closed. So during due diligence, we were able to take off shingles and see the decking. So once we took off the shingles, some of the decking is going to need to be replaced. Some of the boiler registers are in worse shape than others. So we're probably going to be somewhere between 750 and 800 on the construction. But we feel pretty good about the exit being between 6.5 and 7, depending on where interest rates are at and where the rents come in at. We modeled rents at 1150, including RUB, so all in 1150. And we think that that's on
That
the
sounds
conservative
pretty
side
conservative.
for a renovated one bedroom of that size. So we'll see. We feel really good about the 170 a door number, and we think that rents could come in even a little bit higher than where we're at, adjusting that price upward. But it's going to be a phenomenal, and we're going to be in and out of this deal just because of the location and it being, 40 units in that area where we don't hold a lot of buildings. So we, the nice thing is we have the optionality. When we finish, we could refinance the project, recap it, return a bunch of equity to the investors, and then clip, a quarterly coupon and return to the investors, which would be really good. Or we'll have the option of being able to sell it and just getting getting people a multiple on their investment in a shorter time horizon.
Okay. So is there any prepayment penalty with this financing here?
No.
Okay.
No, this is a acquisition loan, which to be competitive in the acquisition loan space, you have to basically understand that your clients are going to take you out.
Yeah.
They specialize in this product, in this kind of business model where you're stabilizing a distressed asset.
Right.
Okay. And they
love
know
that
you're
kind of
going to
play.
sell
Short-term,
or
yeah.
refi, right?
That's right. The loan is actually only for 36 months. So there's 36
Right.
is when
Okay.
we have to, we're either going to refinance or sell inside of 36 months.
And what's your expected total from close to close? Or close, actually, let me rephrase that. What's your expected time from when you close on it, which was 2 weeks ago,
Right.
to when it'll be, fully renovated and leased up?
So construction, we started swinging hammers the day we closed. We actually have some great videos and pictures to show that we can include in the video and in the podcast, in the show notes. But 4 or 5 months, we'll be signing leases. So we predict by the end of March, and the end of March we should be, it's 3 different buildings and then a fourplex on there. So one of the plays is we could actually amend the lot lines and sell the fourplex off separately, because it was just a home that was rezoned as a fourplex, so it is an existing, fourplex. Or we could sell it as 40 units. And we think we could separate that and sell that at a premium because it is a 4-unit stabilized, and a buyer can use an FHA loan and they'll pay a premium for a fourplex there. But we think that we'll have leases going in and people moving in April.
So
It's just all cosmetic, so there's no permits needed, right? We're pulling a permit for the roof, but everything else was just cosmetic. It's paint, carpet, flooring,
Okay.
cabinets, countertops, tile in the bathroom, everything cosmetic. And then obviously a bunch of pest control and things like that. And, there was some mold in some places that we have to mediate. But it'll be a cosmetic remodel. There's no foundation issues. There's, nothing that required city involvement, which would slow it up. So we're able to get in and out and get people in starting in the spring. That's our goal. Hit the springtime hard, and we should have a full building by July, August.
are the units fully vacant now? Or
We've helped. So the remaining
this is
tenants.
tough right now
No,
during
it's
the
very
pandemic.
difficult. Yeah, absolutely. That was had to be. So we have a motel. We have some other properties around town. The previous owner had some other properties, so we agreed to help the tenants transition to other properties. And so we brought a moving vehicle. We've been paying their deposits if they want to go live in other places. So we've been working with the tenants, and it's been really well received. The tenants understand that. A lot of tenants had some massively deferred maintenance. We have some pictures with leaking, a roof that had, ceilings that had been leaking for months, and they had children
people
in there.
living in there?
It was really, really sad. Yeah, so it's definitely going to be for the better. and the tenants are going to get into a much better situation, and we're going to help, pay for the moving expenses, for their deposits, and those kind of things. And then it allows us to get in there and renovate more units and use the winter, which is a poor time to lease anyway. Use the winter to get through all the capex and all the construction, and be leasing in the spring, when it's a prime leasing season.
So I want to kind of go back to the financing here, because so on the construction loan draws, are they having to send out inspectors come check on your work? I'm assuming, do you have to take draws, or can you just access line of credit whenever you want to?
It is set up on draws, and admittedly, I don't have a ton of experience with draws, but this has been definitely the easiest as far as bandwidth. It's
because it's a smaller bank, and they're in Kansas. Basically, we just submit invoices of what we've paid, and they wire the same day or next day. So we got our first draw last Friday. We submitted it on Thursday afternoon, and the wire hit our account on Friday. So much different. They're not sending out inspectors.
They're not actually walking the property or anything, huh?
Well, the other thing is they have my personal guarantee.
Okay.
So they know that we're we guarantee the whole project. But because of this broker's relationship with this bank, I mean, this has actually been our first deal with a mortgage broker, a commercial mortgage broker. And I think here's the value. I think the downside was they charged almost 2 points. So 2 points on the total debt, right? So that's $80-some thousand that we had to pay, at the closing. But what we got in exchange was a really favorable terms, a lot, higher leverage, and a much more convenient construction process.
I mean, it sounds like he earned his commission on that one.
He earned his commission, and that was Ben and I went back and forth, and I was like, dude, we got to get him down. And it was just one of those things where when you weigh the cost and, like I said, the leverage, the terms, and the convenience of the construction process, and he said it from the beginning, this bank, this is why you're going to pay, this is why paying the premium makes sense for you, is you're not going to have to wait a week to get it, you're not going to have a bunch of inspectors asking for a bunch of extra items, because of the speed at which we do construction, especially cosmetic construction, where we're paying our guys every week or 2 weeks because they're in they move really fast, but in exchange for that, they want to get paid every week versus a commercial contractor where they're maybe paying their guys once a month, and pulling permits and just when you're doing a much different scope of project, those guys can get their commercial companies, construction companies, they can float for 30 days. Our guys, they're our own subs. And they're used to getting paid on a regular basis, and so that kind of loan worked really favorable for the way that we do construction.
Now, taking this broker out of the picture, I mean, these are just amazing loan terms you got. I mean, what would have been the other option? I mean, that would have been like what, a
50%, 50 or 60% loan.
Yeah, it would have been
a
purchase.
Like
it would have
total
been
cost for LTV.
It would have been a hurdle, and it would have been definitely a bank that has seen us perform.
Okay.
I don't think we would approach say, hey, we found this building. Even the VA doesn't want to put their tenants in it. It's got all this deferred maintenance, but we're going to come in and save the day. And okay, here's 80% of the value.
Yeah, you're not going to get that.
No. But we would have gotten it done. We definitely would have been raising the construction budget from the partners.
So you would have raised a lot more money with an overall lower.
Yeah, I think a local bank, like when we did the motel, kind of in a similar condition, banks were wanting 50 or 60% of just the purchase price, and they didn't want to touch the construction. Wow. So it probably would have been the same thing. Maybe we would have got 60% of the purchase price, and then we would have had to put in the $800 for the construction. Yeah. So we would have had to raise another $1 million bucks.
So was it just, based off of your guys' track record? Is that what helped really win this deal?
I think the relationship. So our broker on the transaction side to buy the building had a relationship with this commercial debt broker.
Okay.
So having a really good broker that knew the kind of project that was going to help us get it done, because that was one of my big things to the broker when we first looked at it. I was like, dude, I don't even know what kind of debt I can get on this right now, just because of how much more defensive banks are. We've shown them completely full buildings that just need some minor renovations, and they've been defensive on those kind of deals. And in areas where they're much more proven out, in core Denver neighborhoods like Congress Park or Cheeseman Park or City Park, neighborhoods that everyone would say, oh, that's a core Denver neighborhood, no issue raising money or getting the debt for. So in this neighborhood that's a little bit less proven in terms of an apartment building, I knew that it was going to be an issue. And then when you see the vacancy along with the CapEx, those are three major black eyes that are going to be hard to overcome for a bank. So that was one of the first things I said was, I don't know who's going to finance this and how much, what they're going to do. And so we were able to work together, and Ben was a big part of that. Of, hey, this is the kind of bank we're going to need, and then he introduced us to this gentleman that was the commercial debt broker, and he had 3 or 4 solutions, within a week, and this ended up being the best one.
Yeah. My advice for for the listeners is, when you sit down with a banker, you pick up the phone, you want to think right off the bat: is the mandate from this banker's committee board to reduce risk for the next year, or is it to expand loans and get more loans on the books? And if you're a property like this is not even in the realm of possibility for someone that wants to reduce risk. And so the larger banks right now, with everything going on with the pandemic, so your Wells Fargo, Chase, even banks as big as statewide First Bank, they're not incentivized to increase risk to make a couple more dollars. They want to decrease risk. So right off the bat, we knew what kind of so you can kind of, like, we have just a running debt relationship tracker, and we keep notes in there, and so it's pretty intuitive. I wouldn't even call this guy, because he's that's a no before we even.
But you have your finger on the pulse, and you know that from the high
what
level.
what each property is going to need.
Yeah, like we kind of, the way we kind of word it is it's not that the banker usually isn't the one that can write the check and say, there you go. It's their committee, so we're saying, hey,
they all have to go to the committee.
That's right. Yeah. So we're every lunch, every coffee, it's like, what are you hearing from your from the committee? What are you guys looking for as far what's the bank's goals for this quarter, da 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 da, and you'll get a real and you'll know right away if the asset's appropriate.
And that's something you do. Like, you stay in touch with all the lenders, kind of keep your finger on the pulse.
Yeah,
right?
more and more. Yeah, we try to meet with a new lender. Another good question you can ask bankers is, okay, this isn't appropriate for your bank. Who should I be talking to?
Yeah.
And it's not so competitive that they're like, I'm not telling you anyone else. They'll say, oh, call this guy. I know he's done a few multifamily loans on assets like that, or da 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 da. So usually, like anything in networking, one dead end, someone can at least point you off to another one. Yeah.
But you have to ask for it.
Oh yeah. So
I'm just keeping my eye on the clock, guys. We got about 5 or 6 minutes before we need to have our hard stop, move on to all of our next meetings. I looked at the agenda. I know we jumped around quite a bit. Any things you guys want to fill in or details you want to talk about as we wrap up here?
I think the big learning lesson from my standpoint was just being really clear with communicating with the broker on every step of the way. I think that there was multiple times during this deal that I thought we were never going to get it done and we were just going to have to terminate, just because of how much work it needed and how far away we were on price. And we got over a $600,000 price reduction. And so the learning lesson for me was you have to ask and just go through the process. You may get some no's, and in most cases it would have been a no. For this particular instance, because of all the variables, all the variables that were in our favor, it ended up working out. And it was just communicating with the broker. I mean, he wanted to get the deal done, so naturally he saw everything we saw, and he said, "Look, I'm going to go to bat. I'm going to fight for you." And he really believed in it and believed that this is where it needed to be at for it to make sense for anyone.
And because he didn't take it down, every other person have the same issues, the same concerns.
Oh, for sure. And we do construction cheaper and faster in our property management. We're set up to be able to execute this where most people wouldn't be. And so he knew that, hey, if it doesn't work for these guys at this number, it's not going to work for almost anybody. So this is where it needs to go. And I just think the communication and being able to spell everything out and just being having everything organized and laid out. Here's what we got back from the inspection. Here's the numbers. Here's what we're seeing on rents. It's pretty unknown, so we're speculating, so we're going to be a little bit more conservative. And being able to just defend that and show every step of the way to give him the ammunition to go back and say, hey, here's what we need and here's why. It wasn't just like, hey, we need $900,000 off. It was like, hey, seller, the rents are a little unproven because of this. This is the area. This is what we're seeing, so we're not really sure. So here's where we see rents. Here's all the CapEx. Here are all the issues with the building. here's the bids to get it, and here's why we need this number. It wasn't just pulled out of the sky. So just being very clear with the communication, being organized on the due diligence, put us in a position to get the maximum dollars off on the inspection. And I think that's the real lesson here, is that if you have clear communication and you're organized and you present the case in the right way, it gives you the best chance to get the most amount of dollars off on the inspection on these kind of deep value add projects.
And actually, one more question. I was looking at my notes here. We've talked about the financing and working with the seller, but during this environment, especially as we're going into winter, the news is getting more and more choppy with the election at the time. COVID numbers are spiking up. What was the feedback you guys got like as you started raising money from your LPs or potential LPs? Like, what were people saying? Like, what were your investors saying?
I'm glad you brought that up. Most people were very scared. I think just generally speaking, there was like a lot of fear going on. So we only called people that knew our model, had the same kind of view on the market as us. Is like, when other people are scared, we need to get aggressive. But do it with intentionality, right? And be really clear on what the business plan is and knowing that we can execute. And this is something that we've done literally hundreds of times, where we've bought dilapidated properties that have been mismanaged. We've renovated them, we've filled them with the right tenants, and we've executed time and time again. So we knew that we could do it. So we called people that knew that had that same confidence in us and same confidence in the Denver market. That even if nationally the news may be negative towards being a landlord right now, they know that that's just a moment in time, that the data's there as far as like migration to Denver, job growth in Denver, wage growth in Denver, rent growth in Denver, and that even if we have a 6-month or a 12-month, maybe it gets stagnant, or there may be some bad national news in terms of evictions or anything to do with any of that, that long-term Denver is going to win. And those are the people that we called. So the people that we called, actually nobody, everyone, because we only showed it to a handful of people. So we didn't have really any trouble. I think we raised the money actually in like 2 weeks. So it wasn't
harder, the same, less?
No, it wasn't.
You got to think also, if someone says to me, I'm not opening your email, I'm not reading the memo, just tell me how you're going to make me money. On this deal, the answer is we're going to get in at a really low basis, we're going to execute on construction, and we're going to dispose of the building $60,000 higher per door than we bought it. Nowhere in there did I say they're going to pay their rent, we're going to manage it better than the last person managed, we're going to keep vacancy limited, we have great insurance relationships. There's none of that. It's just construction. We're going to execute on construction, and we're buying at a really low basis, and we're going to sell it. And so that eliminates a lot of the fear as far as like, hey, I heard rent payments are down or eviction moratoriums or. So you got to just kind of, and it actually, we didn't say, hey, let's make our next deal a big construction play, because of the virus. It kind of just worked out that way. But really, if I'm an investor, it's not. There's not a lot of this business plan that I need to know that people are going to pay high rents on time and fully for years and years for me to get my money back. That's not in the model at all.
Yeah.
We're going to set the conditions so that happens. Deliver a good product, place good tenants, but the value will be added by construction execution.
Okay.
Yeah, and we were prepared. When we went hard on our earnest money, we went hard on $150,000 non-refundable. So we were fully prepared to close the whole thing with our own capital if we needed to. And that's how much we believed in it. So I think one of the lessons is, if you have your own skin in the game and other people see that and they know that, I think it creates a little bit more confidence from the investors. Like, oh, well, he's already non-refundable. He's putting his own money in. Then I'm willing to. And so that was the truth. Is that Ben and we had some other closings and we were pretty liquid at the time, and I just said, hey, if no one else wants to do this deal, we'll fund it ourselves. I'll write the whole check, because I just know that this is gonna, I've seen it, I've been there before. Now there definitely can be things go wrong. We can get inside the walls and there can be more issues and construction go up, but the core fundamentals are there in terms of like where we bought it at. We're going to add the value. We're going to fill it with the right tenants. We're going to manage it, and we have the optionality. Either we can sell it if the market's still good and debt's still cheap and cap rates are still being compressed, or we can refinance and hold and collect a really good monthly and quarterly cash flow dividend. if that's the route we need to go.
So you have options and you have just margins and where you bought it from.
Absolutely,
Cool.
yeah.
All right, guys. Well, we need to wrap up here. So Terrance, Ben, thank you guys. One last thing, every time we do these podcasts, I think it's number 4 or 5, I get more people reaching out and asking questions, things like this. Like, what can people reach out to you guys for questions, for like, what can people reach out to you for? Because I get that a lot.
Yeah, we enjoy, adding value to other people. That's the name of our company. That's what we really enjoy. That brings us a lot of fulfillment. So if someone out there and they're looking at apartment buildings and they have some questions, they're definitely happy to get on the phone and chat with them. If people are looking for diversification and maybe they're in single family or maybe they're in industrial and they're looking to get into something that is more stable, or they're looking to get into being a more passive investor, we're looking for really strong LPs that can be in a number of our deals and that really believe in Denver and believe in multifamily.
All right, gentlemen. Thank you so much. And website contact details will be in the show notes.
Yeah, we actually have a new website coming soon
That's
that
right.
we've been working hard on, so we're excited to release that.
All right,
That's gonna be
looking forward to
awesome.
seeing it.
Yeah, thanks for having us,
guys.
Chris.
All right.